Installment sales. What's an installment sale? Let's see and dive in. Well, this is a sale of property where the seller receives one or more payments in a tax year that is after the year of the sale. And why is this important? Why are we dealing with this? Well, if I sell you a TV and you give me cash for it, all in year 4, cool. I recognize that in year 4. Nice, simple, easy, regardless if that's cash basis or accrual. Either way, we're recognizing that as income. But what happens if I sell you the TV and you pay me over the next 4 years in installment payments? Now, for tax purposes, the seller reports a portion of the gain from the sale in each year that a payment's received, rather than all of the gain being recognized in the year of sale, because you don't want to have to pay tax on all of this gain right away, because you're not getting cash for it until future years. And why would it be fair that you pay tax on all this tax when you haven't actually gotten the cash? Maybe you don't have enough cash to actually pay the tax, and that would be a little unfair to the taxpayer. The portion of the gain that is reported each year is determined by applying a gross profit percentage to the payments received that year. The gross profit percentage is calculated by dividing the gross profit on the sale by the total contract price, and we'll see some examples of how this works. All right, diving into this much further before we get into some examples. Installment sales, they're a method of accounting for the sale of certain assets where the seller recognizes the income from the sale over multiple periods as payments are received from the buyer. This method is useful for spreading the tax liability from the sale of an asset over several years rather than recognizing the entire gain in the year of sale. However, there are certain rules and limitations. Of course, there's always rules and there's always limitations, always exceptions, always a lot that we have to deal with. Well, here, inventory does not qualify. So I just gave an example that did have inventory, like such as a TV, but that doesn't. Let's talk about maybe more of a contracts, long-term construction example. You're getting paid over multiple years. The installment sales method cannot be used for the sale of inventory or any other property held primarily for resale. This is because the purpose of this method is to provide tax relief for long-term assets that generate significant gains, whereas inventory is considered a short-term asset subject to the normal course of business operations. And then recognizing when cash is received, even if accrual-based financial statements, the installment sales method is an exception to the accrual basis of accounting. Even if a business uses accrual-based financial statements, it can recognize income from an installment sale when cash is received rather than when the sale is made or when the payment becomes due. This is a great point that I like to bring up. This is why you should not take the financial exam tied right back to back with reg. There are many differences, and you'll see installment sales on both exams, and there's different rules, different ways to approach it, as which it is my advice to not take those exams back to back. Give yourself time to kind of decompress and forget the rules and relearn them a different way. All right, now we're going to discuss the formula used in installment sales. We did talk about how we're going to use the gross profit percentage, and let's see how we do that here. Well, this is the difference between the sales price of the asset and its adjusted basis, which is usually, as we've seen, the asset's cost minus accumulated depreciation or amortization. The gross profit represents the gain on the sale. There we go. Nice simple formula. Classic accounting formula you should definitely know. Next up, the gross profit percentage. This is essentially just turning this into a percentage. So we're going to say the gross profit divided by the sales price. And that's, again, another formula. Make sure you know that. You'll need to know that for multiple exams as well. Definitely be familiar with that. And then the gain recognized. This is the amount of gain recognized in each period based on the cash collections received, excluding any interest portion. And that's interesting because also over a multi-year period, we likely have interest. People don't want to just let you borrow money for an extended period of time and not pay interest. So we'll see that as well. The gain recognized is calculated by multiplying the cash collections by the gross profit percentage. And again, I know this is all good and dandy, but seeing it with actual numbers obviously will help. But make sure you write these down, get the formulas familiar in your mind. Overall, again, what's the point of this? It can be particularly beneficial for taxpayers with fluctuating income or those seeking to minimize their tax burden in a specific year. All right, moving along. As promised, here we are, another example, or a example you haven't seen an installment sale example yet, but we've seen other examples. Suppose you sell a piece of machinery for $100,000. You originally purchased the machinery for $60,000, and since then, it has accumulated $20,000 in depreciation. The buyer agrees to pay $20,000 up front, and then make 4 additional annual payments of $20,000 each. Now, you're presumably not holding this as inventory. It looks like you're using this machinery to maybe make inventory or do something else with it. Let's follow our steps that we saw on the previous slide. First, we want to calculate the gross profit, which make sure you have that formula memorized. Your gross profit here is going to be, well, just what are you getting versus what are you giving up? you're getting $100,000. You're getting 20 up front, and then 4 years of 20,000. So you're getting 100 in total, and you're giving up value of 40. So you're having total gains here, total gross profit of 60. Next up, what's your gross profit percentage? Again, just memorize the formula there. $60,000 divided by 100. So this is the amount of percent of what you're receiving in cash, or eventually that actually is profit. And then step 3, what is the gain recognized for each cash collection? So in this example, we're making the following payments. And that's, again, presumably what we saw. We have year 1 is the down payment, year 2, 3, 4, 5. This could be more complex, different amounts. Maybe they skip a year. So just be prepared for that. But this is a nice simple example where it's equal payments every year. So for each payment, we're going to calculate the gain recognized using the gross profit percentage. So that's the gain recognized equals cash collections times the gross profit percentage. So we see here that we just multiply every year by that 60%. So what do we actually recognize in year 1? Well, that's only $12,000. So we see here, instead of recognizing $20,000 when we got that in cash, we're only recognizing $12,000 because that's the gross profit we're actually getting from this whole process. $12,000, $12,000, $12,000, boom, boom, boom. So multiply that by 5. That's our gross profit. Makes sense. Gets us to $60,000. So for each year, you're going to recognize a gain of $12,000 from the installment sale of the machinery, which amounts to a total gain of $60,000 over the 5-year period. Different way of doing it. Question will say, we're using the installment sale method. This is how you're going to approach it. And overall, at the end of the day, it does come out to the same taxable amount, which is $60,000. That's what you would have paid tax on anyway. And that's how we do it. So we knock it out, so we get points, and that's how we move along. Next up in our examples, let's say that a taxpayer sells a piece of equipment for $100,000 and incurs $20,000 in expenses related to the sale, resulting in net proceeds of $80,000. The buyer agrees to make 5 annual payments of $20,000, with the first payment due in the year of sale. Again, we are introducing new items piece by piece to our example, seeing how that changes it. Assuming that all $20,000 of the expenses are deducted immediately, the net selling price becomes $80,000. If the equipment had a 0 basis, the gross profit would be $80,000. So the gross profit percentage, let's do a little calculation there. That would be $80,000 of gross profit divided by the $1,000 of the contract price, giving us 80%. The gain recognized each year would then be 80% of the cash payment received. In the year of sale, the taxpayer would recognize $16,000 of gain, so that's 80% times the $20,000 payment, and we would keep doing that in each of the 4 subsequent years, giving us $16,000 gain in each of those. So over the course of the 5 years, the taxpayer would recognize a total of $80,000 in gain, which matches the original gross profit. Not too bad, nothing too wild, nothing you can't handle. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.